Hey guys, this is Hussein, and in today's video we'll be talking about the difference between the Uniswap V2 and V3. I made a last video about the opportunity of investment in V3, but I really want to explain the exact difference between the V2 protocol and the V3 protocol. So actually how the DeFi's work basically, when you want to exchange one token into another token, then in the normal exchange what happens that for every buyer there is a seller, right? So for example, you hold some ETH, right, and you want to sell them to a buyer, right? Then in normally in the exchange there are some orders, right? So for example, let's say that there are these are the two orders right here, right? And let's say that someone wants to buy the matic, right? Actually someone wants to sell his matic obviously at the higher price. So let's say he wants to sell his matic for, let's say, 0.001 ETH, right? That's just a random price, maybe it's just like that, right? And there might be a person who actually want to buy the ETH, right, at maybe around 0095, right? ETH. So they have placed their limit orders in on the centralized exchange. So whenever a new person came in to place to place an order in the market, so he gets two prices. So this is basically the ask price, right, and this is basically the bid price. So if he is selling his matic, right, then he will be executed at this price, right? And if he wants to buy some ETH, then his order will be executed on this price. So that's how the centralized market works, right? But this protocol of decentralized exchange, there are no buyers and sellers that are at the same place, right? So it's like let me just get rid of this part here. I think I can make it bigger from just pressing my keys, right? Okay, let's just get rid of this centralized concept. So in the decentralized exchange we have equal amount of matic and ETH, and by equal amount it doesn't mean that for one matic, right, we have, let's say, one ETH, right? So it doesn't mean that for every matic we have one ETH. The meaning of having the equal amounts of matic and ETH is in terms of value. So for example, let's say that the matic price is one matic is equivalent to, let's say, that's just a random price. So let's say it is for, let's say, $100, equal $100, right? And let's say the ETH is around let's say one ETH equals to uh, $3,000. That's the price of the ETH at the moment, right? Now uh, for every one ETH there needs to be 30 matics in the pool, right? So for example, let's say the pool has a liquidity of, the pool has some uh, let's say 100 ETHs, right? Then how much matic it will contain, that will be, actually, let me just open my calculator and show you some exact calculations, right? So for every one matic, so for every one ETH we had, like, so we did like 3000 divided by 100, right? So that is about 30 matics, right, for one ETH. So if we have 100 ETH, then we just multiply it with 100, right, and we get 3000 matics token, right? So we need to have about 3000 matic, right? So that is how the distribution happens in the centralized pool, basically, right? Now the difference, actually, when someone some the price is at one point here, right? So if both are at the equivalent price, right, so the price stays here. That means that the price is kind of a stable, and there are equal amount of matic and ETH. But obviously that's not the case, because we have like 100 ETH and we have 3000 matic, right? So the price will be around somewhere here right now, because 1 matic is not equal to 1 ETH. If 1 matic was equal to 1 ETH, then you can just put a 45-degree of angle here, and you can say that okay, because we have equal amount of matic and ETH, right? So it's like, let me just draw it. So for example, we have equal amount of matic and equal amount of ETH. Let's say they are changing, like, so that's one, right? That's one. So that's actually I'm drawing a graph, right? So if we have the same kind of ratios between the tokens, so it will be something like that, right? Sorry, that's 2, then that's 3, right? But obviously, because for every 1 ETH we have around 30 matics, right? So it will go somewhere here, the price will be around somewhere here, right? Now if someone starts selling into the ETH, right, then sorry, someone starts selling the matic, right, actually sorry, so when someone will start selling his ETH, then the amount of the ETH will start increasing in the pool, and the amount of matic will stay the same, right? Actually reduce, right? So the amount of matic will reduce, because obviously when someone is giving ETH, right, he needs matic, right? So the amount of matic will reduce and the amount of ETH will increase. So that's how the this price will go down to this curve. So this curve is kind of already determined curve, so you can call it with the formula as x cross y equal L. So the total liquidity of the pool is like this, right? So that is always going to be constant, right? So if someone is putting some ETH, he will be getting some matic. If someone is putting some matic, he will be getting some ETH, right? So that's how it works. So that's how the decentralized exchange works, right? Now where this liquidity comes from, right? So there are investors who actually put their money, right, in these pools. Let's say that this pool has a liquidity of 3 million, right? And so obviously that 3 million needs to come from here, and some people invest it and they definitely need some return, right? So uh, in the ideal situation, if you have for every 1 ETH equals to 30 matic, right, then obviously that's the case. You give 1 ETH, you get 30 matic, and that's how it works, right, in the ideal case. But what happens is, obviously because an investor needs some return, so instead of giving 30 matic, right, they will deduct some fees. So with the Uniswap protocol V2, it is about 0.3%, right? And obviously there will be some price impact during the execution of the order, because that will create an imbalance in the pool, right? So you will not get actually 30 matic, you will actually get around maybe 29 point something matic. Let's take an example here. Let me just launch the Uniswap application and let me show you this example here. So let's say that uh, we are selling 1 ETH, right? And let's see how much matic we get. So we are using the Uniswap V2 router, and it's like right now it is fetching the best price for us, right? And obviously we are on the Polygon chain at the moment, right? So you see that for 1 ETH, actually that's a lot higher than I anticipated. So we are getting like 1710 matics, right? So right now the price impact is about 0.00%, because obviously the liquidity in the pool is so much concentrated that 1 ETH will not make much difference, right? But obviously if you are selling some higher amounts, that will make some impact, and you might get less as of the ideal situation here, right? So that is basically the V2, right? That is basically the V2. And what is it in for the investor? So the investor actually get this uh, basically they get this fees here, right? So they earn from this fees here, and we call it swap fees, right? So that is 0.3%, right? Now if you want to invest into the Uniswap V2 pool, you have to give the same value of assets in the pool, and they might go up and down in the value, right? So there is a concept of impermanent loss, right? For example, when the one value of the asset starts increasing or decreasing, so for example, let's say that one ETH is equal to 30 matics. One ETH equals to 30 matic, right? And let's say that the price of ETH is about, let's say, that's around $2,800, right? And let's say the price of the matic is about, let's say, $2, right? Now if matic drops in value, right, let's say that, okay, let's discuss about ETH. Now if ETH drops in value and goes to like uh, let's say 2000, right, that means that you are not just losing the value of your ETH that was invested in the pool, but also you will also the amount of ETH. So let's say that during the time of investment you invested 1 ETH, right, and you invested 30 matic. That was your initial investment, right? But now, because the value of the ETH is deflated from 2800 to 2000, so that is around 800 of loss in the value of the ETH. But you just don't lose your value of 1 ETH, but actually you lose the amount of ETH as well, because the ratio of the pool has to maintain the liquidity in balance, right? And let's say that the price of the matic is still 2 matic, right? Let's say it is still 2 matic. Now for every 1 ETH, how much matic there are? There are about so 1 ETH had 30 matic, so now 1 ETH will have around 25 matic, right? 25 matic. Now your assets might look like that you have only 0.7 ETH here, right, which has the value of 2000, and your matic might increase some a little bit, around with the same ratio. So if you have dropped in value a 30%, right, then you will have 33 matic, sorry, not 33, actually you will have, so 33% of 30 matic is around 10 matic, so you might have something around 40 matic, right? But now if you compare the value of here, so here you had around you can say that you had around 28 and 30 cross 2 matic, so that is about, let's say, sorry if the calculations are not very correct, but I'm just trying to give you the concept that you don't lose just the value of your asset, but also you lose the amount of your asset. That is basically the impermanent loss, right? Because if you had 1 ETH, you might have just lost $800, and whatever is the gain and the loss of the matic, you will get that. But here you lose some amount of ETH and you gain some amount of matic, but the amount of matic you gain is not sufficient to cover up the loss that you have lost here. Because it has gone double, because if you had 1 ETH, then you have lost $800, but because you have now 0.7 ETH, right? So 0.7 means you have around only $1,400. So previously you had $2,800. Now it was supposed to be $200,000, right? So the loss was supposed to be $800, but the loss of extra $600 is basically the impermanent loss, right? And it continues to do so as long as you stays in the pool. Doesn't matter where exactly you stays in the price, right? Now let's discuss about what's the difference between the V3. So in V3 you have this concept here that it provides a constant amount of liquidity, concentrated liquidity basically. Let me just grab this from here to give you a better picture of it, right? So you have this, so you invested, when you are investing you also define the range, right? So let's say that 1 ETH is equal to, let's say, 30 matic, going with the same example, right? Now you want to put your investment only for the range of, let's say, 28 matics or let's say 32 matics. So if the price stays in between, then your reserves will, interchange between ETH and matic. But of course if they go outside of the range, right, then your assets will be converted in the one asset, completely one asset. For example, let's say that, let's go to the pool of V3 here, and let me create a new position for you guys. And I'm opening here the width. So we are talking about, so we are going with the 0.3 pool here, right? Now it is showing me in terms of matting. Let me see, show you that in terms of, so right now the current price is 1711. So for 1 ETH you are getting 1711 matics, right? Now if you want to select the range of, let's say, starting from 1800 and going to just, let's say, 1000, right? That means that you only need to supply matic. Now when the price comes into this range, your sum of your matic will be converted into ETH, right, and interchangeably, and you will be also gaining some fees because the price is in your range, right? And let's say that the complete price goes to, like, let's say it is like 3000 here, and it is like, let's say, 2500. Now your complete asset will be converted into width, right? So the benefit of this is you only get this impermanent loss when you are in this range here, right? So only at that time you get this impermanent loss. Whenever the price leaves your range, your assets are completely converted into one particular asset, either, let's say, ETH or matic, and you are just losing the value of the asset now. Now if the value of the asset increases, right, you will get profit. If the value of matic increases, you will get profit, and same is the case for the loss. But there will be no extra impermanent loss that I have explained here. That was extra $600 with this calculations here. I told you that you are not just losing $800 because you invested 1 ETH, but the amount of ETH is also reduced to 0.7 ETH. So your total loss is about extra $600. So that is around $1400. So that extra $600 is the impermanent loss. So with this V3 protocol, you reduce your impermanent loss, and also that brings a risk of the investment, that if the price is not in your range, then you are not earning any fees, right? But that also reduces the risk in some way, that you have only one asset, and if you term it with a stable coin. So for example, if, let's say, I try with let's say if I try with WETH and, let's say, USDC, so that's a stable coin, right? So it's matic and USD, right? Now if the price goes to, like, so it is in terms of matic. Let me make it in terms of USDC. Okay, so for every one matic we are getting $1.6, right? So if we reduce it to, let's say, the minimum price is 1.6. let's say if we reduce it to, let me just do that. Right. So now if the price if the price goes above your range, all of your asset will be converted into a stable coin of USDC. So there will be no market loss, no impermanent loss with the stable coin, right? And obviously, but if your, let's say, the price goes below your range, right, then all of your asset will be converted into matic. Let me just show you that. So for example, your liquidity was above this range, above this price, right? Then all your asset will be converted into matic, and you will be only getting the market loss. The asset value of the matic is increasing or decreasing, so that is your loss or the profit, right? But you will not be getting any impermanent loss. But with the V2 variant, you keep getting impermanent loss as the value of any of the asset depreciates, right? And you don't just get that single loss. Your loss is actually, more than 1x. So it is sometimes 1.3x, sometimes 2x. So that depends on how much the value of that asset depreciates. And if the other asset value increases, then that covers the impermanent loss. But if it stays the same in our example, right, then you actually get that impermanent loss, right? I hope you like that video. So if you need to watch some more educational videos, so just subscribe to my channel and hit the bell icon so that you get the notifications of all the new videos. And of course, tell me in the comment sections that how you like the video. And if you need more content like this, just let me know and I will explain those difficult concepts. Thank you.